Thank you again for joining us for our Truth in Lending RESPA Final Rules on Integrated Mortgage Disclosures webinar. My name is Seda Kemp, and I'm a marketing manager with Clifton Larson Allen. Before we get started, I'd like to cover a couple housekeeping items. If you experience technical difficulties, please dial 800-422-3623. Due to the amount of material we have to get through today, we will be utilizing the entire hour for content. Therefore, if you do have any questions, please contact your CLA compliance consultant. If you haven't already downloaded the presentation slides, another copy of the slides, as well as the webinar recording, will be emailed to you within the next 10 business days. And finally, we invite you to fill out the surveys you pop up to leave the webinar. Your feedback helps us to build strong programs in the future. If you would like CPE for today's session, there are 2 requirements you need to be aware of. First, you are required to respond to the polling questions throughout the presentation. These questions will appear on the upper right-hand corner of your screen above the Q&A box. Your response is automatically tracked when you click on the radio button next to the question. There will not be a submit button. If you are in a group setting, you must complete the CPE sign-in sheet, including the attendance monitor signature, and return it to me within 2 business days. You should have received an email from me with this sign-in sheet. If you do need a copy of the form, please email me. My email address is on the screen. If you do qualify to receive CPE credit, a copy of your certificate will be emailed to you within 4 weeks. And please note, this webinar, once recorded, has not been developed into a self-study course. Therefore, watching the recording will not qualify for CPE credit. For those of you who may not be familiar with us, Clifton Larson Allen is a professional services firm with 3 distinct business lines, including accounting and consulting, outsourcing, and wealth advisory. The firm serves more than 1,100 financial institutions in the country, and we have 3,600 staff members from offices coast to coast, including 200 professionals and more than 25 principals who focus exclusively on financial institutions. So without further delay, I'd like to introduce today's presenter. John Zasada is a principal with CLA and leads the financial institution regulatory compliance practice. He assists financial institutions nationwide in establishing regulatory compliance programs, conducting compliance testing, training staff on regulations, and performing website compliance assessments. Before I turn it over to John, I'd like to go over today's learning objectives. At the end of the webinar, you'll be able to recognize TIL RESPA applicability to mortgage transactions, identify the new disclosure forms and retention requirements, and differentiate between requirements in the proposal and final regulations. So John, let's move forward with the presentation.
Thank you very much. Thanks, everyone, especially for your patience in joining us today. We are focusing on many of the high points of the new Regulation Z RESPA mortgage rule integration. We all recognize the enormity of the rule. Even though the final rule is not effective until August of 2015, the Federal Reserve has already presented 3 one-hour and hour-and-a-half long webinars on different facets of the rules, and more webinars will be released in the coming months. When it's all said and done, we could be looking at up to 10 webinars on this rule alone, which is far more than any regulatory compliance change. Consequently, while it's impossible to cover all of the nuances in the rule, of course, in the next hour, I will point your attention to several critical components of the rule in order to help you start to prepare your institution for compliance by August of 2015. Today I'll also include several Q&As to help us focus on some of the most common trouble spots in interpreting the new rule thus far. We've heard from several of our clients so far of looking at the rule in certain areas are already proving problematic, and they're not even getting into filling out the new loan estimate or closing disclosure. So we're going to talk a lot about those common compliance issues that have already arisen. We anticipate, though, many of the questions in the coming months will come from the loan estimate tolerance and the closing disclosure revision section of the new rule. So we are going to spend a little bit more time on those 2 areas. But before we get into the nuances of the rule, we first want to set the table. We want to look at the regulatory compliance environment that banks and credit unions are operating in so that you'll understand how to best prepare your institution when they come in to look at how you're complying with the Truth in Lending and RESPA mortgage integration. So it's really important to understand how this mortgage integration rule fits in with all the other regulatory compliance changes that have taken place. We'll look at the applicability of the rule, of course, timing, the estimate disclosure, the tolerances, the closing disclosure, and finally, how to revise that closing disclosure. As you can see, in 2014, and as you're well aware, we've had thousands of pages of regulatory compliance changes. We are definitely seeing more compliance violations in the real estate lending area than in the previous year. Compliance performance in real estate lending area is worse in the wake of the changes that have occurred this year. It, of course, remains to be seen what the level of compliance violations is going to look like after Truth in Lending and RESPA are integrated. We have actually heard some industry experts say that they think Truth in Lending and RESPA compliance is going to improve after these changes. My personal opinion is I'm not so sure of that based on the webinars that have been conducted so far by the Fed. I found many of the points that they're addressing to be quite confusing with lots of gray areas and lots of things that are going to have to be worked out. And there's more to worry about than these regulatory compliance changes here. Beyond each of the individual changes, we have the interaction between the new and the existing regulations. No one knows the cumulative effect of that quite yet, and we really have to wait until after next August to find out how this all plays out. Because if you look at your crystal ball and you look at all these mortgage rule changes, it certainly appears that the majority of the changes of what they could change in mortgage lending is going to be over next August. Now, as soon as I say that, what might jump into your mind is the new HMDA proposal that just got issued. That is going to have an enormous impact, but it's not the delivery of the disclosure so much it's going to change, although you will have 37 new data fields potentially that you'll be collecting information on. So we're far away from being done with these changes as it relates to your regulatory compliance management program. These changes that have taken place in 2014, financial institutions are not happy about them. You have a recent survey that showed that only 4% of financial institutions see a positive impact from these changes, either on the financial institutions or on consumers. And the primary complaint is that community-based institutions were not the reason behind these changes. They weren't the reason behind the financial crisis. And yet, because you offer the same products and services as those entities, that did cause, in part, the financial crisis. You have to bear that burden of these regulatory compliance changes because you offer the same products and services. As I mentioned, we have upcoming changes. Of course, we're covering one of those today, Truth in Lending and RESPA being integrated, but we're already seeing revisions to the 2013 rules. Based on what I'm seeing initially with the Truth in Lending and RESPA integration, it won't be the end in August 2015. We are going to see changes to that rule after August of 2015. Unlike, though, some of these 2014 rules, I don't anticipate that there's going to be changes to the final rule before the final rule is even released. We did see that last year with respect to the changes that just came into effect. Flood insurance will be changing, the rules regarding flood insurance. HMDA, as I mentioned, is going to be changing. That probably won't be effective until 2016 as far as the collection of that new information. Annual privacy notices, that's a change for the better as far as how you can provide those privacy notices. Something outside of mortgage lending that will be changing, certainly, is overdraft protection and courtesy pay. You have the majority of debit card overdraft fees are incurred on transactions of $24 or less. Half of the time, consumers bring those accounts positive within 3 days. consumers are paying on average $34 for those overdraft items. If that was a loan, that would equate to a 17,000% annual percentage rate. The CFPB thinks that's way too high, so we'll see some changes around that. As far as these changes are concerned, there was a study done by a university where they showed that most community-based financial institutions find these mortgage changes more burdensome than the Bank Secrecy Act. And that's saying something. The difference is we didn't see, except for the smallest of institutions, them get out of the business, so to speak, get out of a financial institution and merge with another financial institution based on Bank Secrecy Act. Some of the smaller ones did, but by and large, most kept doing what they were doing before. These mortgage changes are much different. We are seeing financial institutions get out of certain types of mortgage lending because of the changes that have already occurred. We have not heard that as much about these changes that are going into effect in 2015. That could change, though, in the coming months as financial institutions dig deeper and try to determine the costs of having to comply with these changes that we're going to cover. Enforcement actions. Safety and soundness enforcement actions are down, which means regulatory compliance enforcement actions have increased. Flood is the leading cause of enforcement actions against community-based financial institutions, and the number of flood enforcement actions has increased. The good news there, though, is that flood enforcement actions are generally small. They're relatively smaller dollar, anywhere from $5,000 to $20,000 penalties. These are not millions and millions of dollars in penalties, such as those for Bank Secrecy Act or for fair lending. Bank Secrecy Act enforcement actions are up. We're seeing examiners who are not scrutinizing transaction testing like they used to. They're spending more time looking at the sufficiency of independent testing and SAR monitoring software. They want to make sure that SAR monitoring software is being calibrated and being updated based on your member and customer base. Fair lending enforcement actions are up. UDAP, unfair, deceptive, or abusive acts and practices. Enforcement actions for UDAP violations are up. That relates to the compliance violations in general. Whenever you have a violation of a consumer protection requirement, a UDAP violation can always be stacked on top of that. If you're not complying with the new Truth in Lending and RESPA disclosures, not only have you violated Truth in Lending and RESPA, but you also have a UDAP violation, because if you're not doing something that you're required to do under a consumer protection regulation, then what you're doing could be deemed unfair or deceptive or abusive. So always keep that in mind. In general, examiners are following the money. They're focusing on those products and services that make the most money, that have the largest increases in revenue, and that's where you're seeing more enforcement actions. Now, as we switch gears and we look at compliance violations, you'll notice that Truth in Lending and RESPA are the leading causes of compliance violations. Regulation Z has the most compliance violations because it's the most complicated. It's been around since 1968. And in all that time, financial institutions still cannot figure it out and cannot completely comply with it. Why? Because it's hard. Because it's sporadically tinkered with and added onto. You have requirements that aren't in the regulation but are in the commentary. And you're forced to try to extrapolate from the commentary and put those into a rule. It's very difficult. We'll have to see how Truth in Lending and RESPA compliance, what those violations look like after these changes, because most of the compliance violations for Truth in Lending are on the mortgage side, not on the consumer side. They're on the mortgage and the real estate lending side. Very, very complicated, as you know. RESPA, Truth in Savings, Flood Insurance, Regulation B, those are the areas of compliance violations. The number one compliance violation is inaccurate finance charge on closed-end real estate loans. That probably won't change with the new rule combining Truth in Lending and RESPA, because the way that finance charge is calculated, thankfully, is not changing. We'll discuss at the very end how that rule was going to be changed. That would have been very, very difficult for the industry. The number of compliance violations for finance charges would have gone up. The other big compliance violation is for HUD-1 inaccuracy. Now, the HUD-1 is going away. We're going to have a new closing disclosure. Wait to see whether we're still going to have a lot of compliance violations in that area. Complaints. Complaints are very, very important because complaints are driving the CFPB's new rules. Where you see the most complaints lodged with the CFPB is where you find the most regulatory compliance changes. 49% of all complaints with the CFPB are for mortgage violations. That's why we're seeing all these changes. The reason we have the Truth in Lending and RESPA integrated rule is because of all the complaints about the Truth in Lending form and the RESPA form and the overlap and how sometimes they didn't agree with one another. It's the whole reason we have these changes. Credit cards, 16% of all complaints are due to credit cards. The problem with that is that we already went through the Credit Card Act. We went through all those changes with the Credit Card Act, thousands of pages of changes. You effectuated those changes. We don't find a lot of credit card violations when we're testing for credit cards and credit card compliance. So you're doing it right, and yet consumers are still complaining. I mentioned that this is a problem. It's a problem because we're probably going to find the CFPB issuing more regulations around credit cards because it's still confusing for consumers. And frankly, it's confusing for financial institutions as well. Complaint volume has doubled in the past year. And according to government data, in 63% of the cases, a financial institution will resolve a complaint with an explanation. But in 27% of the cases, the financial institution resolves a complaint with monetary or non-monetary relief, meaning they're giving something back to the consumer. They're refunding fees or there's some other offset. That higher percentage is concerning to the CFPB. They look at those complaints and they think, you know what, in 27% of the cases, the consumer was right. And they're finding that financial institutions are fixing the complaint or addressing the complaint with respect to that one consumer, but the financial institution isn't looking at the underlying cause of the complaint and fixing it for everyone. So as you're looking at your compliance operations, complaints are an enormous area. One takeaway from the webinar today is to have a complaint management process. The examiners are asking to see your complaints. They want to see how they're resolved. But importantly, they want to see them resolved not only with respect to that particular complaint, but the underlying cause. You look at the root cause of it and make the change system-wide. Make the change so that anyone affected by that complaint and whatever you weren't doing correctly, that everyone is made whole. It's not all bad news. A third of all banks have been examined by the FTC are rated 1, meaning they have no compliance violations or only a few technical violations. A third of banks, 8% of banks had a worse compliance rating than the year before, but 14% had a better compliance rating than the year before. So compliance overall has improved according to the examination results. We feel the reason for that is that a lot of financial institutions, probably some of you, have ramped up compliance. More time and resources is spent on regulatory compliance. Even before these changes went into effect in 2014, you had additional compliance resources that were improving regulatory compliance across the board. It'll be really interesting, though, to find out what the examination results are for 2014, because as I mentioned at the outset, we are finding more real estate compliance violations than ever before. As you're looking at Truth in Lending and RESPA integration, and it will be our very next slide, as you're looking at that and bringing your institution into compliance with that rule prior to August, don't forget about your overall regulatory compliance program. If you don't have a good centralized compliance management program, what we keep hearing over and over and over again is that the examiners are going to look closer at compliance in individual areas. So if you want examiners to look less at spend less time examining your efforts at Truth in Lending and RESPA mortgage integration compliance, have a good overall regulatory compliance program. Do self-assessing, self-identifying, self-correcting, self-policing for regulatory compliance. Look for compliance violations internally. If you're using a resource like ourselves, you want to keep a record of the violations that we detect, the recommendations we provide, and what you're doing to correct each of those. And if you can provide that to the examiners, chances are they're going to spend less time doing transactional testing for regulatory compliance. They're going to look more at your overall compliance program. The agency as a whole, and we heard this from the very top from the director of the CFPB, they subscribe to a philosophy of, is this a product or service that you would go through with your grandmother or grandfather? When you're looking at your disclosures, when you're looking at your products and services, could you explain them in such a way to another individual where they could completely understand that product or service? If you can, chances are you're going to have a good examination. The CFPB started with 12 employees. They now have over 600, and they're looking to hire additional staff, both to write the rules and to examine. And even though your institution probably is not examined by the CFPB is setting the tone for other examiners, and they're also writing all of the new rules. The new rule. The new rule is almost 2,000 pages long. The implementation deadline is longer than for most new rules, as the effective date, of course, is not until August. However, it's going to take your institution a lot of time, a significant amount of time, to bring it into compliance. This is the time to form some sort of committee, some sort of group within your institution to come up with a plan for compliance. That plan has to involve third parties. You're going to have to involve those third-party vendors that are helping you with the forms. They have a lot of resources. They have a lot of means to help you come into compliance. So make sure that you bring them into this early on in the process. As I mentioned, the CFPB has already had 3 webinars on the new rules, and there's more to come. They've also issued a 91-page small entity compliance guide. If you haven't looked at that, I would suggest that you do so. It's already been updated once. They've issued a 14-page Truth in Lending and RESPA integration disclosure timeline example. The timeline examples show in a calendar form the process and timing of disclosures for a sample real estate purchase loan. It's very helpful. And there's also a 98-page guide to the loan estimate and closing disclosure form. Note that during this webinar, though, we're focusing more on the timing and the presentation and the issuance of the disclosures rather than how to actually complete those forms. In the coming months, we're going to have a webinar that specifically addresses that. And you can find all of those helpful guides on the CFPB's website. For years, we've had 2 sets of disclosures, 2 sets of disclosures at the application and at closing. And now we have 1 each. This should help. I mean, for years you had 2 different agencies issuing the regulation. One agency issued Truth in Lending, another RESPA. There was a lot of conflicting information. That should improve. And while it's been known for a long time that those 2 agencies, in the rules that they wrote, there was conflicted information in there, nothing was done about it until the CFPB issued that rule in 2012. It went through a ton of testing. There's still going to be bugs in it, but there's been a ton of testing done. All told, there are 2,800 comments on that proposed rule. To put that into context, there was just guidance issued by the CFPB for social media compliance, and it calls for you to have a social media compliance program. That is something that we're not aware of many institutions having. Even though that was released, there were only 80 comments on it, not the 2,800 comments like there were for the Truth in Lending and RESPA integration. Applicability. The new rule applies to most closed-end loans regardless of asset size and the pricing of the mortgage. It doesn't matter that it's a high-priced mortgage loan. There's no small creditor exemption under the rule. However, consistent with the existing rules, if you don't make more than 5 mortgages in a year, then you're exempt. Most closed-end mortgage loans are going to be subject to these disclosure requirements. HELOCs, reverse mortgages, those are not subject to the new rules. However, the new rules are required for construction-only loans, for loans secured by vacant land, and for loans that are secured by 25 acres or more. Currently, those types of loans are not within the scope of RESPA, but they are the subject of the new Truth in Lending and RESPA rule. It would be nice if you could comply early in this case. It would be nice if you happen to have all your ducks in a row by June, that you could start using the new disclosures before August, but you can't. The new integrated disclosures must be used on or after August 1st. You may not use the new disclosures for applications received prior to August 1st. There's no provision for early compliance. Early use of the disclosures would result in a violation. The way you start the loan is how you close the loan. So if you take an application on July 29th, 2015, you have to provide the old GFE Truth in Lending disclosure. If that loan then closes on August 12th of 2015, you have to provide the old PUD and Truth in Lending disclosure. The problem is that for a few months, banks and credit unions are going to have dual loan platforms to provide the appropriate disclosures, depending on when that application was taken. This is going to be messy for a period of time. I would anticipate we're going to find a lot of violations. And on that note, though, regarding violations, please go back to what I mentioned at the outset. Having a compliance program is going to make this whole process of the examination a lot easier for you. If you can show the examiners that you had a committee established months before the rule went into play, that you were working with your third-party provider, that you were working on the disclosures, that you tested it, that you found some things that weren't correct, that you went back and corrected them, that sort of work will make your examiners more lenient when they find violations. And invariably, with a rule of this size, violations are going to occur. But anything that you can do to mitigate that risk is going to help you. And one way to do that is to be able to show the efforts that you made to comply. So currently, you need to provide a good faith estimate and an early Truth in Lending disclosure. The new loan estimate, it replaces both of those forms and is 3 pages long. It generally is required to be provided within 3 business days of receiving the loan application. So it means that the loan estimate must be delivered or placed in the mail within 3 days of receiving that loan application. Now, the definition is important. For the purposes of the loan estimate, a business day is a day in which your offices are open to the public for carrying out business functions. For many of you, this will not include Saturdays. Commentators on the proposal said that to count Saturdays as a business day would impose a significant burden because you're not open. And as a result, the time frame to issue that loan estimate would effectively only be 2 business days. Note that the term business day is defined differently for the closing disclosure. For the closing disclosure, business day means all calendar days except Sundays and legal holidays. For mortgage brokers, in terms of a mortgage broker, if a mortgage broker receives the application, the mortgage broker can provide the loan estimate on behalf of the creditor. However, it's up to you to maintain communication with that broker to make sure that the loan estimate is delivered properly, because if it isn't, then it's your institution that's going to be liable. I mentioned the 3-day time period. There's also a 7-day time period. So there's 2 time frames to be aware of for the loan estimate. The loan estimate must be delivered or placed in the mail no later than the 3rd business day after you receive the application. But you must deliver or place the loan disclosure in the mail not later than the 7th business day before consummation of that loan. The term business day has 2 different meanings even within the loan estimate. For the purposes of the 3 business day rule, the definition of business day, of course, is the day in which your institution's offices are open to the public. That will not include Saturdays. But when calculating the loan estimate for the 7-day period, business day means all calendar days except Sundays and legal public holidays. Let's look at the situation of multiple applicants. If there is more than one applicant, each applicant's name and mailing address must be listed on that loan estimate. And the loan estimate can be delivered to just one of the applicants. But if it's a rescindable transaction, then each applicant must receive a copy of the closing disclosure. Here's a bit of a change. Definition of application. According to the new rule, an application consists of submitting the following 6 pieces of information that you can see here. You have the name, income, social security number, property address, value of the property, and the mortgage loan amount that is being sought. The new definition is similar to the current RESPA definition. However, the CFPB has revised the definition of application, so it removes that 7th catch-all element of the RESPA definition. That catch-all is any other information deemed necessary by the loan originator. That's no longer in there. The application can be submitted, of course, in written or electronic format. It includes a written record of an oral application. Question, are you allowed to require additional verifying information other than those 6 pieces of required information before providing a loan estimate? And the answer is no. You are not permitted to condition providing that loan estimate on a consumer submitting documents verifying information related to the application before providing the loan estimate. And we have some more questions. What if the consumer does not specify the loan term or the product type? Well, the answer is, since it's not one of the 6 required pieces of information, you still must provide the loan estimate to the best of your ability. You can try to obtain the product type of the loan term, but you cannot require it before providing an estimate within that 3-day window. What if the online loan application, it contains the 6 pieces of required information, but the consumer does not submit it, meaning the application information is saved online, but it's not submitted? The answer is you're not required to provide a loan estimate unless the application is actually submitted, regardless of how much information is saved on your website. And what if the applicant's online application contains the 6 pieces of required information, but not the information the financial institution deems necessary? Can your institution reject that application? And the answer is no. You still must consider an application. Based on what we've heard initially from banks and credit unions, we anticipate that some lenders are considering avoiding collecting one of the 6 application pieces to delay having to provide that loan estimate. For example, a lender may purposely not collect an applicant's social security number until they determine the precise type of mortgage loan the applicant is interested. It'll be interesting to see how that plays out. Let's briefly look at the loan estimate itself. As I said, we're not going to go into great detail on how to fill out these forms. We will in a future webinar. The webinar by the Federal Reserve went into great detail last week on the loan estimate. Page 1 of the loan estimate contains basic information about the loan and specific information about the loan terms, how payments may change, estimate closing costs, and there's also a link there for consumers to obtain more information about real estate loans on the CFPB's website. You can use your institution's logo along with your name and address as long as the logo does not exceed the space provided for that information. There's no specific font type that's required for the loan estimate, but the regulation does tell you what specific loan or font sizes you can use. N/A may not be used on the loan estimate. You should leave that space blank instead. The itemization of amount finance and the finance charge are not required to be on that loan estimate. Page 2 on the loan estimate, loan costs are on the left side. The other costs are on the right side. Loan costs are those costs paid by the consumer to the financial institution and third-party providers of services that you require to be obtained by the consumer for that loan. Other costs are going to be taxes, government recording fees, and other payments. Page 3 contains contact information, a comparison table, and if you want, you can include a signature statement for the consumer to sign to acknowledge receipt of it. Of course, you're responsible for ensuring that the figures that you're using on that loan estimate are in good faith and are consistent with the best information available to you at that time. Whether or not the loan estimate is in good faith is determined by calculating the difference between the charges originally provided in the loan estimate and those ultimately paid by the consumer. If the charge paid by the consumer exceeds the amount originally disclosed on the loan estimate, it's not in good faith. And this is true regardless of whether you later discover some sort of technical error or miscalculation. However, a loan estimate is considered to be in good faith if you charge the consumer less than the amount that was disclosed on that loan estimate. Now, there are exceptions, of course. For some costs, you are permitted to charge consumers more than the amount disclosed on the loan estimate without any tolerance limitation whatsoever. Those charges are going to be, as you can see here, a prepaid interest, property insurance, amount placed in escrow, services that are required by you if you permit the consumer to shop and they select a third party not on your list, and charges paid to third-party service providers for services not required by you. And remember, that charge must be based on the best information reasonably available to you at the time you provided the disclosure. We have a 10% tolerance. Charges for third-party services and recording fees paid by the consumer are grouped together and are subject to a 10% cumulative tolerance. This means that you may charge the consumer more than the amount disclosed on the loan estimate, so long as the total sum of those charges does not exceed the sum of all charges disclosed on the loan estimate by more than 10%. So again, these 10% charges are your recording fees and charges for third-party services where it's not paid to you, and the consumer is permitted to shop, and the consumer selects a third-party provider on your list. Zero tolerance. There are types of charges where you're not permitted to charge consumers more than the amount of the loan estimate under any circumstances other than the changed circumstance that we'll cover shortly. The zero tolerance charges include fees paid to you and fees paid to an unaffiliated third party if you do not permit the consumer to shop. What do you do when the amounts paid exceeded those amounts that were disclosed on the loan estimate initially? The answer is you have to refund the excess to the consumer no later than 60 calendar days after consummation of the loan. For charges that are subject to zero tolerance, is any amount charged above the amount disclosed on that loan estimate that has to be refunded. For charges subject to 10% cumulative tolerance, is to the extent the total sum of those charges exceed the sum of the charges disclosed on the loan estimate by more than 10%. You would refund that difference. And again, you have to do that within 60 days of the loan consummation. In addition to that loan estimate, if the consumer is permitted to shop for a settlement service, then you must provide a written list of services for which that consumer can shop. That written list is separate from the loan estimate, but it's provided at the same time. It has to be provided no later than 3 business days after you receive the application. That list identifies at least one available settlement service provider for each service, and it states that the consumer may choose a different provider of that service. The service providers identified on the written list must match up exactly with those that are disclosed on the loan estimate. You may identify on that written list of providers those services for which the consumer is not permitted to shop, as long as it will not confuse the applicant, and they can distinguish those that they can shop for from ones that they can't shop for. If you're not going to allow a consumer to shop for services, then you do not need to provide that list at all. When are revisions or corrections permitted? As you can see here, in several different circumstances. First, we have a change circumstances. Change circumstances that occurs after the loan estimate is provided, which cause the settlement charges to increase by more than is permitted under the rule, or the change circumstances affects the consumer's eligibility for the terms that they applied for. You can also issue a revised loan estimate if the consumer requests revisions, if the interest rate was not locked when that loan estimate was provided, and locking the rates causes the points or credits to change. If the consumer indicates an intent to proceed more than 10 days after the loan estimate was originally provided. And there's a new rule for construction loans. For construction transactions, if you expect that the closing will occur more than 60 days after the loan estimate is provided, you are permitted to issue revised disclosures anytime prior to 60 days before consummation without regard to the limit regarding revising estimated costs, as long as that loan estimate clearly stated that revised disclosures may be issued anytime prior to 60 days. What is a changed circumstance? What's an extraordinary event beyond the control of either party, and it's specific to the consumer and it's something that was relied upon? You must deliver the revised loan estimate to the consumer no later than 3 business days after receiving the information that established that the loan estimate needed to be revised. You need to deliver or place in the mail the loan estimate no later than 7 business days before consummation of the transaction. It imposes, of course, our 7-day waiting period, and you cannot consummate that loan within those 7 days. If settlement is scheduled during the waiting period, you cannot use the revised loan estimate. Question, can you provide a loan estimate after a closing disclosure already has been provided? The answer is no. You cannot issue a revised loan estimate on or after the date you provide that closing disclosure. Can a consumer waive the 7-day waiting period? They can, but much like the existing rule regarding waiving these sorts of periods, the circumstances are very limited. It has to be a bona fide financial emergency. An example of that, of course, is the imminent sale of a consumer's home at foreclosure, where the foreclosure sale will proceed unless those loan proceeds are made available during that waiting period. In order to modify or waive that waiting period, you need a dated written statement that describes the emergency and must be signed by all the consumers that are liable on that loan. You cannot provide a pre-printed form. Regarding that 3 and 7 day timeline for the loan estimate, note that the CFPB has issued the disclosure timeline, which describes the process and timing of the disclosures for a sample real estate purchase transaction. I think you'll find that helpful. You want to be careful of the fee limitations. There are limits on fees that can be charged prior to the disclosure or the application. You may not impose any fee on a consumer in connection with a mortgage application until the consumer has received a loan estimate and they've indicated an intent to proceed. You cannot collect a credit card number to hold from the consumer until they provide the intent to receive. We have heard from some clients that they will need to change their current procedures to comply with that rule. So a fee is imposed if you're requiring a consumer to provide a method of payment, even if the payment is not made at that time. So that's going to apply to your application fees, appraisal fees, underwriting fees. The only exception is for a bona fide and reasonable fee for the credit report. How does the consumer indicate an intent to proceed? They can communicate in any manner after the loan estimate has been delivered unless a particular manner of communication is required by your institution. Silence is not indicative of an intent to proceed. Your financial institution should definitely document that communication of the intent to proceed in order to satisfy the record retention requirements that we'll cover at the very end. You can provide an estimate of costs in terms of a loan before the loan estimate is provided. You have to be very careful, though, that that estimate of the estimate isn't confused with the actual loan estimate. If you're going to provide an estimate before the initial loan estimate, it must clearly and conspicuously state at the top of the first page that your actual rate, payment, and cost could be higher, yet an official loan estimate before choosing the loan. It has to be in 12-point font, or no smaller than 12-point font, rather, and it may not have any content, headings, or format that could cause a consumer to confuse it with the actual loan estimate and, of course, the closing disclosure. The closing disclosure. Currently, you have both the HUD-1 and the final truth in lending disclosure. The new loan closing disclosure replaces both of those forms. It contains several new disclosures and settlement information. The regulation and the commentary have line-by-line instructions for completing those, but what we found already during the webinar is there are substantive changes here. It will take some time to get used to what information is called for and how to compute that information. The new closing disclosure must be received at least 3 days before consummation. If you deliver it in person, it's received on that day. If you mail it or you provide it electronically in compliance with the E-Signature Act, it's considered received by the consumers 3 days after it was delivered or placed in the mail. The loan closing disclosure can be provided earlier than 3 business days, of course. There's no problem with providing it earlier. The definition of business day has a different meaning than the definition of business day for the loan estimate and the 3-day requirement. Business day is going to be all calendar days except Sundays and legal holidays. May the consumer waive the 3-day business day waiting period? Yes. Much like the 7-day waiting period for the loan estimate, same rules are going to apply. You have to have a bona fide financial emergency, and you have to have a dated written statement. It has to be signed, and that you cannot use a pre-printed form. All right, very quickly, page 1 has a loan terms table, the projected payments table, cost at closing. Page 2, you have the loan costs and the other costs. Items that are required to be disclosed, even if they are not charged to the consumer, cannot be deleted. You've got page 3, and you have the closing disclosure, the calculating cash to close table, and the summaries of the transactions tables. Page 4 and page 5 contain information about whether the loan is assumable, whether it has a demand feature, the ability to refinance the loan, escrow requirements, tax deductibility, whether servicing of a loan may be transferred, borrower liability after foreclosure, and it has a loan contract detailed. Again, in a future webinar, we'll be going over how to calculate and how to fill those out. Average charges. Are you allowed to impose average charges instead of the actual amount received? Well, generally, no, but there are provisions for doing so. You can do average charge if the average charge is no more than the average amount paid for that service. You're defining the class of transactions. You use the same average charge for every transaction within that class, and you do not use this for any type of insurance. We're receiving a lot of questions on revising that closing disclosure. You must redisclose the cost on the closing disclosure if certain changes occur to the transaction after it was provided. And there's 3 categories. You have changes that occur before consummation that require a new 3-day waiting period, changes that occur before consummation where you don't have to wait 3 days, and changes that occur after consummation. Again, you're not permitted to provide a loan estimate after a closing disclosure has been provided. So what changes before consummation require a new waiting period? You must provide a corrected closing disclosure if one of these 3 things occur. First, the disclosed APR comes inaccurate. Second, if the loan product changes. If the loan product previously disclosed changes, then you need to provide them with a closing disclosure that describes that corrected loan product. And if you're adding a prepayment penalty, you need to provide a new one. For other changes before consummation that don't fall within these 3 categories, you still must provide a closing disclosure with the corrected terms and ensure that they receive it, but you do not have to wait an additional 3 days. What if a consumer asks for a revised closing disclosure before consummation? Well, for changes other than those to the APR, the loan product, and the prepayment penalty, you're not required to provide the consumer with a revised closing disclosure until the day of consummation. However, a consumer can inspect the closing disclosure the business day before consummation. So if a consumer asks to inspect it, you're required to present it to them, and it has to reflect any changes. You can't have your settlement agent provide that. Are you required to provide a corrected closing disclosure if terms or costs change after consummation? In some circumstances, yes, you have to. You must provide that corrected closing disclosure if it occurs within the 30-day calendar period after consummation and it causes a closing disclosure to both become inaccurate and results in a change to the amount paid from what was previously disclosed. When you're required to provide a corrected closing disclosure, you must place in the mail no later than 30 days after receiving the information sufficient to establish that. Clerical errors. Are clerical clerical errors discovered after consummation subject to the redisclosure obligation? They are. You have 60 days, though, instead of 30 days to correct those. A clerical error is one that doesn't affect the numerical disclosure and doesn't affect timing, delivery, or other requirements. So if you identified an incorrect settlement service provider as a recipient of a payment, that would be considered clerical. If the closing disclosure, though, listed the wrong property address, that error would not be clerical. There are a few other disclosures that need to be provided as well. One to keep in mind is the escrow closing notice. The escrow closing notice must be provided prior to canceling an escrow account to any consumer for whom an escrow account is required to be established. Differences between the proposed rule and the final rule. There are some substantive changes here. The proposed rule would require that any change necessitated another 3-day waiting period before closing. A lot of the comments from the industry objected to that, and ultimately that was narrowed. So now there's only a few situations where you have to include that waiting period. One of the more controversial aspects of the proposal would have been to redefine how APR is calculated. We've actually heard from some institutions that they thought that this did go into effect. It did not. You can calculate the APR the same way that you used to. That was not changed. The proposal would have required you to keep copies of loan estimates and closing disclosures in an electronic format. You can keep them in electronic format, but the final rule doesn't require you to do so. And the Dodd-Frank Act requires lenders to disclose the approximate amount of wholesale rate of funds in connection with a loan. The proposal would have required you to include the approximate cost of funds on the loan closing disclosure. However, when the CFPB tested this, they found no benefit to consumers, so that was not put into the final rule. And finally, records retention. You have to keep the closing disclosure for 5 years. You have to keep the escrow closing notice for 2 years. The loan estimate must be retained for 3 years. If you transfer ownership of that loan, you must provide a copy of that closing disclosure to the new owner, and you still must retain that disclosure, the closing disclosure, for 5 years. In conclusion, it's important to recognize that if you've not done so already, you should establish an implementation team to manage this process, to bring your institution into compliance with these changes. You're ultimately going to need to work with your third-party providers on new forms, processes, and then there's the hardware and the software. Several different aspects of your lending operation are affected: origination, closing, post-closing, servicing. The entire compliance process will take a significant amount of coordination with lots of different individuals and entities. Now is not too soon to get started. And that concludes our webinar. Thank you very much for attending. And if you have any questions in the coming months, please contact your CLA compliance consultant. Thanks.